Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate specialist, and I'm joined today by our global market specialists, John Briggs and Giles Gale. So I'm going to start with Europe this week because I would say it's certainly we're only one day in actually in the UK to the week, well, 1.5 days now, but it really has been what's been driving global bond markets, I would say, over the past few days, because we've had this notable shift in ECB speakers, starting with Lane actually last week, but then backed up by Valois, and then I guess more typical hawkish speakers like Knott and Holtzman. But we've had a clear shift in a hawkish direction, signaling that the pace of QE for Q4 will be reassessed at next week's meeting. So I guess, Giles, just would like to hear from you about what you kind of make of this, what you think this actually implies for next week's meeting and the pace of QE beyond that.
Yeah, well, I think it's fairly clear. It's always interesting when you're only hearing from one side of the debate. And, in this case, I think that it's pretty clear that the Hawks want to get their case out there. And, I think they've got a pretty strong case, to be honest with you. I think it's, a pretty strong base case now that they will change their the guidance about the way that they're conducting the PEP. Remember that back in March, they said that they were going to increase the PEP to a significantly higher monthly pace than they had been conducting in the first part of the year. And they subsequently did that, increasing the net purchases under PEP from about 60 to about 80, which means total net purchases, once you include the other stuff that they're buying in the traditional QE program, of about 100 billion, and that grosses up to something like 150 ish in gross terms. So I think now, given that they, clearly should be very pleased with what they've achieved in terms of preserving or even increasing the sort of these easy financing conditions that they wanted to underpin, I suppose, with that policy. Pretty much every indicator that you could look at is at an easier setting than it was. We think that the baseline that they're really referring to is December last year. Compared to then, almost everything is easier. And we've been tracking very strong growth. So all those downside risks that maybe muddied the picture back in March, those have not gone away, but they certainly haven't materialized. And I think that the COVID risks are significantly less pronounced than they were back then. So I think it does make sense for them to take a little bit of a step back. So we are now expecting them to do so. They won't tell us exactly how much. A bit of a debate just amongst us on the team whether they might pare it back to something like sort of maybe from 80 billion in PEP on a net basis to 70 or 60. It's going to be something around there, we think. Not dramatic, but enough over time to be noticed. And I think that there's this has a psychological importance for the markets as well, because I guess particularly over the summer, there was this feeling that they were basically just going to fine-tune their purchase pace to hit the full to fill their envelope. They've got this envelope of 1.85 trillion total purchases that they're supposedly allowed to make under PEP, and they were essentially setting a pace to fill that by next March. And so now perhaps that they might not feel that that's such an important thing to do.
What about beyond next March? At the last meeting, that was the July meeting that just came after the conclusion of the strategic review. So we got the updated forward guidance, but that was all about rates, really. There wasn't much on QE. And we've always had our base case assumption that QE would be some form of QE, whether that be PAP or called something else, would be extended beyond March 22. Does this change your base case around that at all? Or is this just really a step down from what were probably really emergency settings in this significantly higher pace? And we shouldn't kind of overinterpret this as the beginning of a taper or anything like that.
No, I think that's exactly it. I mean, listen, it is a taper, but it's a very slight one, and it's only really sort of taking. It's they stepped up, and now they're perhaps stepping back a little bit. So while it is a taper, and in some sense, I mean, and it should be considered such. It's not part of an ongoing program. They're not going to tell us, this is the course that we're now going to set for 2022. This is how we're going to get back to net zero or anything like that. So it's not a taper in that sense. For next year, it doesn't really change anything that we thought about what's going to happen after March. We never thought that March was just going to be when PEP was switched off, and we just go from a very, very high base of total asset purchases down to essentially whatever the 20 billion the kind of underlying baseline that we had before before PEP began, and has been continuing all along and is very rarely talked about. It was never going to just step down like that. I think that they probably end up extending the PEP, and then if there's an unused portion from the current envelope, then that would just be rolled forwards and used flexibly over whatever period that extension happens to be, whether it's 6 months or 9 months. And that's more or less what we have in mind. So next year will be about tapering. They'll have a lot more to tell us about how they will approach that. It's probably going to be sort of state-based rather than here is kind of the taper schedule. But by state-based, what I mean is according to economic conditions and so on. But there will be more for them to tell us about that. We just probably won't hear what that is, I don't think, until most likely December, possibly later.
From a market's perspective, then, is this the ECB, sort of telling us that they will now be happy or not push back against such a low level of rate? Sorry, they would be happy with a higher level of rates, so they won't push back against kind of rate rises so heavily. And I guess that's a kind of two-pronged question, both on core rates, but also what they might think about the level of sovereign spreads as well.
I think it is. It's. I mean, it's not a. Again, this isn't something that we should be overstating, but I think clearly it is. They don't need to push back against the markets, or some underlying tendency in the market to look for slightly higher rates, as they did back in March. And now I'm just going to read this because we were talking about it a little bit just amongst us beforehand as being a bit of a confusing comment from Lane in his interview, where he says that we've seen this year significant shifts in investor demand, and such investor demand shocks are relevant in thinking about the appropriate calibration of net asset purchases. So what does he mean there? It's a little bit sort of ambiguous, I suppose. But my reading of that was essentially that there are times that they've viewed there as being times when investors just don't get it, and you have to you have to push back. And if you want to call that some kind of volatility control or whatever you want, then that maybe is essentially that gets at the essence of what they were doing. I think that they need to get away from that a little bit, and now there is less need to push back against I guess the tendency towards pricing rates according to fundamentals a little bit more. So yeah, I think slightly higher rates, that would be perfectly okay for them. And wider spreads, I'm less sure, to be honest with you. I mean, we're relatively tight spreads, so I'm sure that a little bit wider wouldn't matter that much. Markets might want to test in that direction just in the short term, because there's this idea that sovereign spreads are so heavily reliant on PEP. But overall, we're neither all that worried about it, and I think that the spread component is probably something where the euro system, where the ECB is probably a little bit more sensitive. We've talked before about the role of financial stability having kind of been elevated in the ECB strategy review, and financial stability over the last 10 years or so has really been mostly about sovereign spreads. That's sort of the start of the chain, and so that's something they're going to have to continue to look at very carefully.
All right, thank you, Giles. Well, we will be catching up again after the ECB next week, so we'll kind of have the benefit of knowing what they actually did, and we'll be dissecting that in next week's podcast. Over to you then, John, in the US, because it's all about Fed watching there, really. Before we get on to, I guess, this week and looking forward to the data, let's just quickly catch up on Jackson Hole last week. Because when we recorded the podcast last week, it came out just after Jackson Hole, so we haven't had the chance to kind of debrief listeners on what we learned from Jackson Hole and how, if at all, that's kind of changed our base case for the Fed taper path.
No, it didn't really change anything. I mean, I think there was some expectation with a lot of the Fed presidents speaking hawkishly about taper or prepping taper, that Powell might signal something, but we had, and many others did, really think that he wasn't going to signal anything, because then he would lose his optionality when it came to this coming payroll report and over setting up expectations. I mean, if he had said, yeah, we're on path to taper, and then the employment report came out very low, then it kind of looks a little bit foolish, or might have to backtrack. So not a ton out of Powell. There's a little bit of discussion around the idea that he said that, clear progress towards their goals on the employment side would continue to be, something like the 3-month average, which is around 830,000. So there's a little bit of expectation in the market that maybe you need to see that kind of growth in payrolls in order to meet the employment side of the mandate. And, as a reminder, he also, though, did say that, as Clarida signaled a few weeks ago, which we've discussed in this podcast, that they have met their inflation side of the mandate. They feel like that has fulfilled under flexible average inflation targeting. So you really just need the employment side to keep up in order to progress towards reducing monetary accommodation. So what that number is, I think this podcast is probably going to be published right around the time of the data release. So, as usual, I get the great timing on things, but we'll see. I will add one more thing, though, that Clarida had a CNBC interview, which he did say that he doesn't think we need 800 plus, just need job growth to be robust. So I think that was his way of walking that back, maybe a little bit, and saying that it's a little bit more nuanced when it comes to what's needed to meet that mandate.
So maybe not 800 plus, but still robust. What is that kind of a number? We're looking for, as you say, this is probably going to be published right after the payrolls number. So maybe we'll edit this bit out if it's really off. But our base case is for 525,000 jobs on NFPs. So is that just sufficient to keep the Fed on our kind of base case timeline, which is an announcement or signaling in September, announcement in November? And if that's the case, then what kind of a number might you be looking for to shift that timeline in either direction?
Yeah, so I have to say, Kevin Cummins, the economics group here in the U.S., has had almost nailed the number the last 2 or 3 months. So even if it is a miss, they get a break every now and then. So we have 525. I think that's fine. That's robust enough to kind of keep things on track. But and to be on, again, when we think they might do some sort of signaling in September, they're going to keep a lot of optionality. As long as continued progress ensues towards our goals, then we expect to taper in the next several meetings, or in the next, or now, something along those lines. The exact wording may not be as important as just kind of the spirit of it. But anything that's probably kind of, and again, this is super subjective, but 400 or lower, or on. And then if you do get something more that's kind of robust, but not what we've seen in the 500-600, that next payroll report, the September report reported in October, again, is going to be another waypoint that we're going to look at. So if you have kind of the trajectory going from 800 to 500 to 300, that may worry some of them. If it's going from 800 to 500, then back to 800, then you're fine. So, the next few payroll reports really do have a heightened sense of importance. But also, even just around the headline number, what's also going on with participation rate, or people coming back to workforce now that schools are open. Again, that's really next report, not this one. This report, the Hawks could say, well, listen, that was the heart of Delta, it was August, and that's when this report survey week was. So next one should be better. Again, all that debate is probably going to keep them, even if they do signal for a taper in September, that they're going to keep a lot of optionality open. And I think the kind of market's there though too. So, I will say though, just I'm going to preempt, I think, what your question is going to be. If you get a very strong number, maybe like 1 million plus, then you're going to have a discussion and debate about whether that maybe moves up the timeline. Because again, August has a lot of reasons to be a little bit lower, or a slowdown in pace that you could find some excuses for. In the face of COVID, if it's 1 million plus, the Hawks could really get going, and maybe there would be some pressure to have a September announcement for October, for an October start. I will say that the important waymarker for the coming week is going to be Williams has a speech next week. So how does he feel? What is his message? Because I'm pretty sure that if he discusses it, it's going to have Powell's stamp of approval.
That was going to be my next question. So my final question then, I guess just sticking with kind of payrolls and the data, we've obviously had ADP today, which was weaker than expected. Will the Fed be paying much attention to that? I don't want to ask you too much about what that really implies for NFPs, because obviously this is going to come out later, and we know that relationship isn't particularly significant anyway. But will the Fed be paying much attention to that weaker number, or is it really all about the NFPs?
No, I mean, ADP doesn't have the greatest track record. It tends to undershoot by a fair amount, a couple 100,000, especially in this post-COVID period. So I think that if you have a decent payroll number, this won't really impact that much. Other things, I think, like if we've seen some pullbacks here. I mean, ISM data has been super high, so you should expect some pullback. Maybe it's been a little deeper on the service side. I think some of the consumer confidence numbers that have come down a lot more than we've thought, how those kind of numbers work out over the next several prints. Your service PMI stuff, I do think it has a little bit more important than manufacturing side, which has a lot of supply chain and orders issues and things like that. So, I think kind of that service consumer side numbers, retail sales, they're going to also have importance when it comes to, even as the job market, which sometimes can lag some of that stuff, some of the more forward-looking indicators, in the next couple of weeks, I think are things that we should be watching out for.
So still lots to look out for. All right. Thank you both for joining me. That was, I think, been an interesting discussion this week. Lots to watch. And we'll catch up next week, like I say, when we'll have the benefit of knowing what NFPs were and the benefit of knowing what the ECB did. And just a reminder to all of our listeners that if you liked today's episode, then please hit the like button to show your appreciation and click subscribe so you can listen to our latest episodes as soon as they're available. And just a reminder, I did have one question that I was going to ask this week, but I think we've actually run out of time really. So I'm saving it for next week. But if there are any other questions that you would like to pitch to our Bondcasters, then please send an email to bondcast@natwest.com. Thanks all.